As of the close of the most recent trading session, KEEL Infrastructure Corp., listed on the NASDAQ under the ticker KEAL, finished at $3.18 per share, reflecting a sharp single-day decline of 14.86%. Market trading is currently closed, but following this steep pullback, after-hours movement showed slight stabilization around $3.22 per share. While the headline numbers look like a routine sell-off in a volatile small-cap technology stock, the actual structural reality inside this business reveals something far more complex. Wall Street has spent months treating KEEL Infrastructure as a pure-play artificial intelligence landlord, riding the explosive demand for high-performance computing centers. Yet beneath that popular narrative lies a company undergoing a high-stakes balance sheet restructuring that is temporarily crushing short-term equity value even as its long-term power assets grow. The public expectation surrounding KEEL Infrastructure is straightforward. Retail traders scanning popular investment apps see a company with over 2 gigawatts of power pipeline, prime real estate in high-demand power markets like Pennsylvania, Washington State, and Quebec, and a shiny new corporate identity tailored for the artificial intelligence gold rush. The story seems simple. Take old industrial footprints, plug in graphics processing units, sign long-term hosting contracts with big tech firms, and collect steady cash flow. That belief pushed the stock up toward its 52-week high of $7.37 earlier this year. However, the reality facing investors on their individual brokerage screens paints a very different picture. Moving from cryptocurrency mining into enterprise-grade data hosting requires massive upfront capital expenditure. Transforming raw grid connections into high-density liquid-cooled data facilities takes hundreds of millions of dollars before a single dollar of high-margin lease revenue hits the income statement. When you examine the recent volume spikes and institutional flows on your trading platform, you quickly realize that the recent drop down to $3.18 is not just noise, it is the market pricing in heavy equity dilution, capital raise execution risks, and a temporary margin squeeze that sits right in the middle of this structural pivot. Looking closely at recent trading behavior, daily volume in KEAL has swung well above its multi-week averages, touching over 40 million shares traded in recent sessions as retail and institutional investors clashed over valuation. Institutional players looking at Fidelity mutual funds, Fidelity ETFs, or broader small-cap benchmark allocations inside Fidelity investments have had to weigh major balance sheet announcements. For example, the recent $400 million convertible notes offering gave the company necessary liquidity to build out its infrastructure, but it also introduced potential share overhang that scared short-term traders. When a company issues debt that can convert into equity at a later date, hedge funds often short the underlying stock to hedge their convertible positions. That algorithmic selling pressure, combined with momentum traders exiting via Robinhood stock trading and Interactive Brokers trading, accelerated the downside slide from the $4.50 range down to current levels. At the same time, sell-side analysts present an intriguing divergence. Major research firms like BTIG recently initiated coverage on KEEL Infrastructure with a buy rating and an $8 price target, pointing to the underlying valuation of power capacity in North America. Power interconnections have become the ultimate bottleneck in modern computing. Securing hundreds of megawatts of energized grid access in places like Pennsylvania's Panther Creek or Scrubgrass campuses can take 5 to 7 years through conventional utility interconnect queues. KEEL already holds those energized sites. So why is the stock trading at a fraction of that analyst target? The answer lies in timing and cash burn. Wall Street analysts build models based on full site build-outs 3 years from now, while daily retail market participants on the Robinhood app or SoFi Active Investing are reacting to current quarterly net losses and operating cash burn. To evaluate whether this disconnect represents an opportunity or a trap, it helps to review how KEEL Infrastructure Corp. actually operates today. Founded originally as Bitfarms, the company established a footprint across North America by securing power assets to mine digital currencies. Over the past 2 years, management recognized that raw electrical power, high-voltage transformers, and physical land campuses were vastly more valuable when supporting high-performance computing and enterprise software workloads. Operating facilities across Moses Lake in Washington State, Sharon and Scrubgrass in Pennsylvania, and Sherbrooke in Quebec, the company controls critical infrastructure in regions where regional power grids are tightly constrained. Their business model is transitioning into a dual-track strategy. On one side, legacy operations continue to generate cash flow from existing server capacity. On the other, capital is being aggressively funneled into site expansion, substation upgrades, and specialized cooling infrastructure needed for next-generation computing clusters. The goal is to sign long-term, multi-decade master lease agreements with enterprise clients, converting unpredictable yield into predictable annuity-style corporate revenue. Yet history shows that infrastructure transitions are rarely smooth. When examining past financial filings on your Fidelity trading platform or Interactive Brokers account, you can see how past operational expenses and hardware depreciation cycles created volatile earnings swings. In previous quarters, revenue expanded rapidly, but gross margins suffered whenever power costs spiked or old computing hardware reached the end of its useful life. The market remembers those legacy metrics, which is why many conservative investors viewing options through Fidelity Wealth Management or Schwab Intelligent Portfolios remain hesitant until long-term lease agreements are officially finalized and operational. Drop a comment below right now and let me know, do you think power-hungry computing sites are the most valuable asset in tech right now, or are companies like KEEL taking on too much debt to build them out? When you weigh expectation against reality, the central question for anyone managing an individual brokerage account or analyzing self-investing strategies comes down to execution speed versus financial dilution. The market expectation assumes that because artificial intelligence software demands enormous power, every owner of a power substation will automatically print massive profits. The reality is that power is not enough. You need the balance sheet strength to survive the construction phase, the technical capability to meet strict enterprise uptime requirements, and the financial discipline to avoid diluting existing shareholders into oblivion before those contracts start producing profit. Consider how this plays out across different online investing channels and investing sites. An investor using SoFi Invest, SoFi Stocks, or SoFi ETFs might see KEEL featured among high-growth technology trends. Another investor using Robinhood Cash Management or Robinhood Fractional Shares might buy small positions based on social media chatter about power shortages. Meanwhile, institutional managers using Interactive Brokers platform tools or Fidelity IRAs look closely at Interactive Brokers' fees, cost of capital, and net asset value per share. If KEEL Infrastructure has to issue additional equity at $3 or $35 per share to fund construction, the long-term value per share decreases even if the total company assets grow larger. Looking ahead toward upcoming catalysts, several key factors will dictate where this stock trades over the next 6 to 12 months. First is the upcoming quarterly earnings announcement and conference call, where management must provide clear updates on lease negotiations, power conversion timelines, and capital expenditure guidance. Any announcement of a firm contract with an enterprise hyperscaler could immediately alter investor sentiment, causing short sellers to cover and pushing the stock back toward its 52-week high. Conversely, any delay in utility approvals, equipment delivery schedules, or site build-outs could extend the current downward pressure, forcing the price to retest lower technical support levels near its 52-week low of $1.14. Second, macroeconomic pressures and interest rate expectations play a direct role. Digital infrastructure build-outs are capital-intensive. Higher borrowing costs mean higher interest expenses on corporate debt, making capital raises more expensive. If interest rates ease, financing becomes cheaper, accelerating development across all campuses. That's why tracking bond market movements and Federal Reserve policy is essential for anyone doing online investment or seeking investment help for tech infrastructure stocks. Finally, sector momentum across major mega-cap technology leaders will continue to influence daily trading. Price movements in Tesla stock, Apple stock, and Nvidia stock often dictate broader risk sentiment across the entire technology sector. When high-beta chip makers and AI leaders experience buying pressure, speculative capital flows down into small-cap infrastructure providers like KEEL. When mega-cap tech stocks consolidate, speculative capital dries up quickly, leaving high-beta stocks like KEEL vulnerable to sharp retracements. To bring this full circle, the current narrative surrounding KEEL Infrastructure Corp is defined by a deep rift between short-term market reality and long-term asset value. The market expectation